Welcome to the Pacesetter Pod, where we explore and reveal the perspectives, insights, and approaches to deliver great results and growth in your agribusiness through better execution. Here's your host, the Integration Pacesetter, Joe Mosier.
Hello and welcome to another episode of the Pacesetter Pod. I'm your host, Joe Mosier. I'm sitting here today at my desk. It's late summer 2024, and most of the headline news results for agribusiness are disappointing. Not exclusively, but largely disappointing. And I don't necessarily today want to opine on any specific results of any one commercial grain trading house or oilseed processing business or crop inputs manufacturer, etc. This is not about any specific companies or ag segments, but what we see happening is structural throughout the industry. We're seeing earnings are down on a year-on-year basis. Forward guidance of the publicly listed entities is mixed. Growth is certainly not evenly distributed throughout the supply chain or even among the competitors within certain segments. And layoffs seem to be ongoing. Admittedly, they're pretty targeted to a specific function or division or location, but the loss of jobs within the sector is concerning. At the same time, of course, we know we're heading into huge crop years and farm income is anticipated to be down. And so there's a lot of headwinds, a lot of dreary news. And this is largely focused, we see these big announcements, it's on the bigger firms, the bigger competitors, established incumbents in our industry. And so what it has me thinking about is the natural and perhaps inevitable limits to growth and how growth at scale over time can become a very real constraint on your business. Yes, we look at businesses and we say they're successful for a variety of reasons, right? They're generating free cash flow. They're being incredibly efficient with capital. They're finding efficiencies within their systems to widen margins or pass on lower prices to customers. But the coup de grace is always growth. Our revenues, net earnings, volumes, are they bigger this year than they were this time last year? And there's a reason for that. Growth is fun. Growth is rewarding. Growth validates the business. It tells you customers want what you offer. They want more of it. It validates the plan. What you're doing is delivering results. But I think growth can also dull and blind us to that inevitable question. What does success look like when growth slows? Or perhaps when growth ends? And I think a lot of the large organizations are running up against some of these constraints of growth. And so today I want to talk about that a little bit more. Not because I think your business is reaching the outer boundaries of its growth potential, but because I think it's intellectually and strategically important that we challenge our own assumptions and beliefs and blind faith in growth as the one real metric that matters. So the first point I want to share today is that growth as a constraint lays victim to everyone, and no one is immune. There is a point beyond which growth is either impossible or impossibly costly. And this is a conceptually logical, though perhaps practically unpredictable threshold. And we'll talk about those thresholds in a moment. And to illustrate that point, I want to look at one of the greatest, most sturdy and reliably sustainable growth stories in American history, and that's Berkshire Hathaway. There's a lot of literature out there, a lot of podcasts, a lot of content you can consume about them. But let me just say this. Berkshire Hathaway has delivered annual average returns since inception, decades ago, near 20%. And that far outperforms the wider stock market. Now, there's some very specific and unique aspects to the investing methodology at Berkshire, but reliable, repeated growth is a through line. Warren Buffett has famously said that he only invests in things he understands. But in its simplest form, Berkshire actually looks for two things when they're making investments. One is they want to see well-performing, established, fair-priced businesses that have the ability to deploy capital at high returns out and into the future. So good businesses today with the ability, if they have capital available, to generate positive returns in the future. And second, they also want companies to be run by quote-unquote able and trustworthy managers. In the 2024 shareholder letter, which was the first since the passing of Buffett's friend and partner Charlie Munger, Buffett reflected that the last 50 years provided, and I quote, an abundance of candidates to evaluate. meaning the market was rich with opportunities of potential acquisitions or investments they could make that would meet their criteria and would deliver outsized returns. In the letter, he went on to say, those days are long behind us. Size did us in. And to give you a sense of what he means by size did us in the letter, and again in quotations here, Berkshire has now by far the largest GAAP, generally accepted accounting practices, net worth recorded by any American business. Record operating income and a strong stock market led to the year-end figure of $561 billion. The total GAAP net worth for the other 499 S&P companies is $8.9 trillion. So Berkshire effectively now accounts for 6% of the competitive universe in which it operates. 6% of the S&P 500 tied up in a single organization. Why is this important and why is it relevant to our topic today? Berkshire Hathaway, the steady, reliable, just champion of growth, has grown to a point where it doesn't just compete in the market, it is the market. And by virtue of that size, they are now reckoning with the fact that they cannot expect themselves, and their shareholders can't expect them to deliver those kinds of returns and growth that it has for so long. So one of the most well-capitalized, most valuable, most rigorous and successful companies in our economy, for them, growth, not capital, has become a constraint.
Poorly executed mergers and acquisitions destroy more value than they create. They can set your company back years. To defend your firm's position in the marketplace, you need access to the leading practices that unlock the greater potential of your people, processes, and systems. If you are undertaking a company transformation or pursuing an acquisition as a vehicle to grow, set up a call with Joe by visiting www.moshercg.com.
And so the second point I want to make is this is not just a product of outsized success by one phenomenally successful company. There's an economic principle that plays out here time and again, and it's called the law of large numbers. In the context of investing, which like a business you're meant to generate a return on your capital investments, the law of large numbers shows that as your business grows over time, it naturally, though not linearly, becomes more challenging to maintain steady growth rates. To put it this way, there's an inverse relationship between growth today and the potential for growth over time. The more growth you've experienced in the past, the higher the barrier to delivering that same pace of growth into the future. So as you grow and expand, your rate of growth is going to contract and become constrained. And it may be obvious to many of you, but if anyone's still scratching their head here, let me do some simple math for you. Let's take an example. And imagine that you're returning $10 million of net earnings this year back to the company, back to the balance sheet, et cetera. And the next year is $11 million. So you have an annual growth rate of 10%, delivering $1 million in incremental net earnings as a result. Repeating that 10% return the next year imputes a return of 1.2, and then 1.3 and change. Then 1.46, 1.6, 1.77, $1.95 million of new incremental earnings every year. After 10 years, your net earnings are going to be 2.5 times where they started on an absolute basis. And that first year where you delivered that $1 million of incremental growth for a 10% net earnings expansion, to hit that 10% growth hurdle, which used to be $1 million, now you need to be close to $2.5 million just from 1 year to the next to stay on pace. So every year, the hurdle to maintain that growth rate becomes harder, and it's just growing every year. 10 more years out, and your annual return is north of $6 million, more than 600% of where you started. So you can kind of see where things are going. It's going to get much more challenging just doing what you've done. And this doesn't even account for all those external challenges like margin compression, fluctuating inputs costs, raw commodity and finished value product values, demand signals, etc. So I think you can probably see how quickly things get so much more challenging. And this is a simplified analysis for sure, but hopefully that point becomes clear. If we pan back now and think about the large, whether it's the ABCD trading and processing houses or the big animal processing facilities, the big crop inputs manufacturers and ag retailers, over time, you have to deploy so much capital to build new facilities, to expand capacity, to extend into new marketplaces. And you're trying to deploy capital to achieve a growth rate, which just becomes, over time, insurmountably difficult to hit. And so I do think, absent investors and ownership moderating their expectations, there is a natural and logical limit to growth. And you could make the argument that some of the large players that we're seeing are actually running up against some of that, considering how we've done business in the past, how they have grown in the past. So third and finally, what is the point here? What I'm trying to get at is that we all need to consider this. Knowing that our historical, our present, and our future growth rates simply cannot go on in perpetuity. What does that mean for your business? And I'm not talking about envisioning some post-growth environment, but maybe consider for a moment, what does a post-present growth environment look like? I want you to pause and confront that potential end game. I think it's strategically additive to do so. Now, some of the options you might be left with is, as I said before, you can moderate your expectations, establish lower growth targets, return less value to shareholders. It's not very sexy, probably not going to be very popular at the annual shareholder meeting, but it's possible. That's one solution. You can try to diversify by holding on to that familiar legacy business while adding new and different and adjacent products and markets and services, etc., kind of the conglomerate model. But keep in mind that there's also this economic principle called the conglomerate discount, whereby as you grow and diversify, there's a tendency of markets to assign a value to that big pool of businesses at a value that's less than the sum of its parts. So you're going to have a valuation that's going to be weighed down by your diversification, yet you're still going to be confronted with that same kind of growth hurdle challenge. You could, of course, another option, you could thin the portfolio and get smaller. I'm not suggesting this across the board, but I think it is an underappreciated option set. Smaller means more focus. It can reset that growth baseline from which you operate, help you set different and more crisp goals into the future, remove some of the noise and some of the weight from the system. Or you can just assess the market and do so in a way that's unencumbered from your current businesses and investments and take a radical look at growth starting from zero. You have the business and the portfolio you own today. You have expertise. You have supply chains. You have customers. You've got distribution. You've got it set up. But where is the market headed? What does this imply to you about the needs? Where are there gaps to be explored? And then where can we pull from our existing portfolio to serve them? And where might we divest? Not because the businesses are underperforming or that they're not performing, but perhaps they're not aligned with some future state. Now, I'd say this is the least common option exercise that I see inside or outside ag, but because typically I think extreme divestiture is born of crisis and desperation. But I'm just sharing it here as a novel way for agribusinesses to try and look at the market and opportunities in a new way. It's a new way to solve an old problem, and that's solving for growth constraints that accumulate from years of success. So as we close up today, again, I want you to just be thinking about the fact that over time, growth actually becomes an impediment to your business, at least sustained growth at a steady rate. And so some key points I hope you walk away with is thinking about the fact that growth is among the most common measurements that we use to assess a business's performance over time. But growth comes with some very real constraints that create challenges commercially, operationally, and financially over time. No one is immune from this. And even our most storied companies and in our industry are confronted, I believe now more than ever, with the constraints of growth. This is not a social or commercial phenomena, but rather it's the output of that underlying law of large numbers at work. And finally, the answer is not to de-emphasize growth or to try to outrun reality, but to use this as an occasion to proactively imagine how your business may need to look or focus or operate differently in the future as a result. It's a chance for you to have a self-imposed head start on a constraint that all successful businesses are eventually going to be confronted with. So I hope this was of value to you today. I hope it gives you something different to think about. And as you digest some of the headline numbers in the media, thank you as always for tuning in today. If you haven't already, please subscribe to the Pacesetter Pod on your podcast platform of choice. If you want to support the show, please leave us a review. You can do it right now. It's how we get the word out, and it's how we improve the quality of the content. We really do appreciate it. And to continue the conversation, you can connect with me, Joe Mosier, on LinkedIn, or set up a call directly by visiting Mosier Consulting Group online at mosiercg.com. I'd love to hear from you. This is all in the show notes. In the meantime, execute well. We look forward to having you join us again right here on the Pacesetter Pod.
This is thepodcastfactory.com.